Imagine intentionally shrinking your company's total revenue by millions of dollars.
Right.
And then taking a massive $10 million financial hit because one of your own major factories just, well, it practically broke down during an upgrade.
Yeah, a total unforced error.
Exactly. And yet somehow looking Wall Street in the eye and trying to convince them that your underlying profit engine is actually getting stronger.
It's a bold strategy, that's for sure.
It really is. I mean, that is the bizarre, counterintuitive high wire act we're unpacking today. Welcome to another deep dive. Today, we are opening up the financial hood on Ashland Inc.
Ticker symbol ASH.
Right, ASH. We're dissecting their highly contested Q1 2026 earnings call, and our mission here is to translate all that dense Wall Street jargon into plain English, figure out what's really happening, and tell you what this means for your portfolio.
Because it is a quarter that it absolutely demands a magnifying glass. I mean, if you only look at the surface level numbers, well, the immediate reflex is just to assume the worst.
The numbers look bad at a glance.
Well, terrible.
Yeah.
But when you actually start pulling apart the specific components of what they reported, you uncover this fascinating narrative. It's about a company that is essentially rebuilding its airplane while it's mid-flight.
I love that. Rebuilding the airplane mid-flight is the perfect way to describe it. But to really anchor this whole conversation, we have to establish who Ashland actually is today.
Right, because they're suffering from a bit of an identity crisis in the broader market right now.
Yeah, they really are. If you pull up an analyst report from 10 years ago, or, even just look at how some trading algorithms categorize them today, they are heavily associated with traditional, heavy industrial chemicals.
Highly cyclical stuff.
Exactly. They were the company making the commodities that swing wildly based on the global economy, the classic boom and bust cycle.
Right. When the economy is hot, they print money.
Yeah.
When it cools down, their margins just get completely decimated.
But that historical reputation is completely disconnected from the reality of their corporate structure today.
Totally disconnected. I mean, management has spent the last several years ruthlessly hacking off those old cyclical industrial limbs.
They've pivoted hard.
They really have. Today, Ashland is an 85% consumer-facing company.
Which is huge. But let's define consumer-facing in this specific chemical context because, they aren't out there selling branded soda or sneakers to you at the mall.
No, not at all. We are talking about the invisible, highly engineered ingredients that power your everyday necessities.
Right. We're talking about the life sciences and personal care sectors.
Exactly. I mean, Ashland is manufacturing the high-value binders and coatings that hold your prescription pharmaceutical pills together.
The stuff that actually makes a pill.
Yeah, and they're engineering the complex active ingredients that go into high-end anti-aging skincare routines, or the advanced sustainable preservatives that keep your shampoo from, well, growing mold on your shower shelf.
So the thesis of the pivot is brilliant. You move away from industrial commodities where you compete on fractions of a penny.
Right, a race to the bottom.
Exactly. And you move into highly regulated, high margin, incredibly sticky businesses. Because if you're buying a premium wrinkle cream or taking a life-saving daily medication,
you don't stop buying that.
Right. That demand doesn't just magically evaporate because the Federal Reserve raised interest rates by 25 basis points.
Exactly. That is the structural moat they're trying to build. A resilient all-weather portfolio. But as this specific Q1 earnings report so vividly illustrates, sketching out a sleek new corporate identity on a whiteboard is an entirely different endeavor than actually operating that new machine in the real world.
Without hitting severe turbulence, yeah. Which brings us to section 1, the actual headline numbers.
The data drop.
Right. We are looking at a quarter that gave investors a lot of conflicting signals. Let's start with the absolute top-line metrics. Total revenue for the first quarter came in at $386 million.
Which represents a 5% drop year over year.
A top-line contraction is never what a growth-oriented investor wants to see right out of the gate.
No, it's an immediate red flag.
And it cascades down. Adjusted earnings per share, the EPS, came in at 26 cents, which is a 7% decline.
Ouch.
Yeah. And their adjusted EBITDA earnings before interest, taxes, depreciation, and amortization, which is basically the core operating profitability, that came in at $58 million, also down 5%.
So down 5% on revenue, down 7% on EPS, down 5% on EBITDA.
It's remarkably consistent.
It is. It paints an undeniably gloomy picture if you're just glancing at a ticker tape on your phone.
But this is exactly where the surface level data lies to you. And it's why we have to dig into the actual portfolio actions. Because that 5% top line revenue drop is incredibly misleading.
It really requires adjusting your baseline expectations.
Right. Let me float a comparison here. Imagine you're reviewing your household net worth at the end of the month, and you panic because your total asset value dropped significantly.
Right. You think you're going broke.
Exactly. But then you look at the ledger and realize, oh, wait, I intentionally sold that old gas-guzzling secondary car last week. Yes, your total assets technically decreased by the value of the vehicle, but your core financial stability didn't weaken.
You just executed a planned, intentional offloading of an asset you didn't want to maintain anymore.
Right, you pruned the tree to make the rest of it healthier.
And in Ashland's specific situation, that gas-guzzling secondary car was a business segment known as Avoca.
Right, the Avoca divestiture.
Yeah. Management made the strategic decision to deliberately divest that business last year.
So it's completely gone from the books.
Entirely gone. And when you look closely at these Q1 numbers, that planned Avoca divestiture accounted for roughly $10 million in missing revenue compared to the same quarter last year.
$10 million out of a total drop of about $20 million?
Yep.
That means a full 2% of that 5% headline revenue decline was entirely self-inflicted and completely expected by management.
Exactly. Which means if we strip out the intentional sale of the Avoca business, the organic sales, the actual beating heart of the ongoing business they decided to keep, we're only down 3%.
Now, a 3% organic sales decline still isn't, a victory parade, especially when you are pitching yourself as a resilient consumer growth story.
Right. You still want that number to be positive.
But we have to look at how that 3% drop actually rippled through their financials. And this is where I found the most surprising metric of the entire earnings call.
The margin profile.
Yes, the margins. Despite the sales volume dropping, Ashland's adjusted EBITDA margins held like a fortress at 15%.
They didn't compress at all.
They didn't bleed out. And that detail is the absolute linchpin to understanding why this corporate transformation is real.
Right. Even if the revenue is currently choppy. Because if we rewind to the old Ashland, the heavy industrial commodity chemical manufacturer,
a 3% sudden drop in sales volume would have absolutely catastrophically crushed their profit margins.
Completely crushed them. And let's explain the mechanics of why that is for anyone who doesn't live and breathe industrial manufacturing.
Right. It comes down to operating leverage and fixed costs.
Exactly. Heavy industrial manufacturing requires massive, sprawling facilities. You have enormous energy costs, specialized labor, and constant maintenance.
The bills you have to pay just to keep the lights on.
Right. Those are fixed costs. They do not change whether your factory is churning out 100,000 barrels of a chemical or just 80,000 barrels.
The landlord still wants the rent.
Yep. So when your sales volume drops by 3%, your revenue shrinks. But your massive fixed costs stay exactly the same. The lost revenue cuts directly, violently into your bottom line profit.
But because Ashland has been ruthlessly pruning their portfolio, selling off the heavy industrial segments,
and aggressively optimizing the manufacturing footprint of the high-value consumer products they kept.
Right, they have fundamentally changed their operating leverage. They proved in this quarter that they've built a shock absorber into their business model.
It's incredibly impressive. They took a hit to the top-line demand in a weird macroeconomic environment. Yet they managed to keep their underlying profitability rate perfectly stable at 15%.
Which requires incredibly disciplined cost controls.
It absolutely does.
And that discipline showed up in another massive way. Cash generation.
Oh, the cash flow is fantastic.
I mean, for a company supposedly struggling with a revenue contraction, they were practically printing cash. Let's look at the raw numbers here.
Yeah.
They generated $125 million in operating cash flow.
Massive number.
And even more importantly, for the retail investor who is trying to calculate a fair valuation multiple, they generated $26 million in pure free cash flow.
Which translates to a 50% free cash flow conversion rate.
And to appreciate how impressive that 50% conversion rate is, you really have to contextualize it within Ashland's normal seasonal cycle.
Right, because their fiscal first quarter, which corresponds to the calendar months of October, November, and December, is notoriously their weakest season.
It's usually their most capital-intensive time of the year. Why is the end of the year so terrible for their cash flow normally?
It mostly has to do with how their customers manage their own balance sheets. Major pharmaceutical and personal care companies want to end their calendar year looking as lean as possible for their own earnings reports.
Right, window dressing for Wall Street.
Exactly. So they engage in massive destocking. They just stop buying raw materials from suppliers like Ashland and burn through their existing warehouses of inventory instead.
Makes sense.
Meanwhile, Ashland has to continue buying raw materials and building up their own inventory to prepare for the massive spring surge in demand.
So cash is usually just flying out the door in December to build up stockpiles, while revenue is simultaneously stalling because customers are refusing to take deliveries until January.
Precisely. It is a dual-sided squeeze on working capital.
So for management to navigate that typical seasonal trough and still emerge with $26 million in free cash flow, it shows they are watching every single penny.
Surgical precision. They're managing their accounts receivable, their raw material purchases, and their capital expenditures beautifully.
And it gives them a phenomenal amount of financial breathing room. They ended the quarter sitting on $900 million in total liquidity.
A fortress balance sheet.
Yeah, their net leverage ratio is sitting at a very comfortable 2.7 times.
Yeah.
They are absolutely not suffocating under a mountain of debt.
No, they have the dry powder to weather an extended economic storm. Or, to aggressively invest in their strategic priorities if the market suddenly turns in their favor. The balance sheet is not the issue here.
Okay, so let's summarize the baseline. The balance sheet is a fortress. The margins are holding incredibly steady at 15% due to structural cost improvements.
Yeah.
And the divestiture of the Avoca segment explains almost half of the headline revenue miss.
Yep.
But that still leaves us with a glaring question that management has to answer. Because if this brilliant pivot to consumer-facing products is supposedly working so well, what exactly dragged the core organic sales number down 3%?
Where is the leak in the boat?
Exactly. Where's the leak? And that leads us to section 2, the story behind the numbers.
Right. And to find that leak, we have to stop looking at the consolidated numbers and dive deep into the individual business divisions.
Let's do it. When you read through the full transcript of this earnings call, it immediately becomes apparent that Ashland's portfolio is experiencing a severe tale of two cities dynamic.
The divergence between their different divisions is jarring.
It really is. It perfectly mirrors the current divide in the global macroeconomy. You have a surprisingly resilient consumer sector constantly battling against a deeply recessionary industrial and manufacturing sector.
It's night and day.
So let's start with the bright spot, the thriving metropolis in our tale of two cities, the life sciences segment.
This is exactly the kind of business they want to be prioritizing, and it really proved its worth this quarter.
It did. It grew 4% year over year, pulling in $139 million in revenue.
And, we shouldn't dismiss 4% growth as minor.
No, definitely not.
In an environment where major chemical companies are posting double-digit declines, generating 4% organic growth in your largest division is a massive testament to the essential nature of these products.
Absolutely. The technical terms management continually highlighted as the growth drivers were pharma excipients and injectables.
Right.
Now, for the listener who hasn't spent years working in a pharmaceutical formulation lab, let's break down the mechanics here. What is an excipient, and why is it so lucrative for Ashland?
It is the unsung hero of modern medicine. When you take a pill, whether it is a simple over-the-counter ibuprofen or a highly complex cardiovascular medication, the actual active pharmaceutical ingredient.
The drug that actually does the healing.
Right. That active ingredient often only constitutes a microscopic fraction of a milligram. You literally cannot pick it up. It looks like a speck of dust.
And you obviously cannot manufacture, package, distribute, or swallow a microscopic speck of dust.
Exactly. It has to be transformed into a physical, manageable form. That is what an excipient is. It is the highly engineered delivery vehicle.
So it's basically just the filler.
Well, no, it is so much more than just inert filler. Yes, it provides the physical bulk to create a tablet, but excipients also serve as the binders that keep the pill from crumbling into powder in the bottle.
Oh.
They serve as the specialized coatings that protect the active drug from being instantly destroyed by your highly acidic stomach acid.
That makes sense.
And they are chemically engineered to control the exact rate at which the pill dissolves. So they ensure the medication enters your bloodstream in a steady trickle over 12 hours, rather than hitting your system all at once in a massive, dangerous spike.
So Ashland is essentially providing the high-tech glue and the molecular armor for billions of pills globally.
They are a dominant player in high-value cellulosic excipients. And the beauty of this business model is the extreme stickiness of the revenue.
Because it's regulated by the FDA, right?
Exactly. Once a major pharmaceutical company formulates a blockbuster drug using Ashland-specific excipient, and they submit that exact formulation to the FDA for approval, they are locked in.
Because if they try to switch to a cheaper competitor's excipient a few years later to save like a fraction of a cent,
they have to prove to the FDA that the generic excipient won't alter the dissolution rate or the efficacy of the drug, which requires extensive, incredibly expensive new human testing.
So they just never change it. The switching costs are too high.
Never. Ashland secures the contract, and they collect reliable revenue for the entire multi-decade lifespan of that drug.
That's amazing. And they noted incredible momentum in their tablet coatings business on the call, specifically highlighting double-digit year-over-year growth in the Asia-Pacific region.
It's a huge growth market for them.
But the excipient story gets even more interesting when you look at the regulatory landscape. The transcript specifically pointed to their low-nitrite cellulosics as a major growth driver. What is the context there?
This is a perfect example of how complex regulations act as a massive competitive moat for premium suppliers like Ashland.
How so?
Over the last few years, global health regulators, including the FDA and the European Medicines Agency, have been cracking down intensely on the presence of trace impurities called nitrosamines in pharmaceutical products.
And nitrosamines are probable human carcinogens, right? They cause cancer over long-term exposure.
Yes, exactly. And these impurities weren't necessarily being added intentionally. They were naturally occurring byproducts of certain chemical manufacturing processes, or they were forming when different ingredients interacted within the pill over time.
Scary stuff.
Very. When regulators started finding trace nitrosamines in common blood pressure medications and heartburn drugs, it triggered massive global multi-billion-dollar product recalls.
Which is literally the nightmare scenario for a pharmaceutical CEO.
Absolute nightmare. Billions of dollars in lost revenue, destroyed brand trust, and massive legal liabilities.
So what happened?
So the entire pharmaceutical industry went into a panic. They started desperately searching for raw materials guaranteed to be free of these specific impurities.
And Ashland was ready with a solution.
They were. They proactively engineered and launched new, highly purified, low-nitrate versions of their flagship excipient product lines, like Plasdone and Benecel.
Oh, wow.
Yeah, they completely altered their own manufacturing processes to ensure these impurities couldn't form.
So now the major pharma companies are sprinting away from cheaper legacy suppliers and flocking to Ashland.
And they're happily paying a premium price for it.
Because Ashland's low-nitrate excipients act as an insurance policy against a catastrophic FDA recall.
Exactly. You do not try to save a few pennies on the binding agent when your entire $10 billion drug franchise is at risk of being pulled from pharmacy shelves. That regulatory panic directly fueled the 4% growth in the life sciences segment.
It's an incredibly strong position to be in, and that was just the excipients. They also highlighted their injectables business, which seems entirely disconnected from the pill market.
Completely different set of challenges there.
Right. They launched a new product this quarter with a name that sounds like a sci-fi prop. It's called a high-purity vialosucrose destabilizer for biologics.
I know, the terminology is incredibly dense, but the underlying mechanism is fascinating and represents a massive growth frontier.
Break it down for me.
To understand this, we have to look at how medicine is changing. The pharmaceutical industry is aggressively shifting away from traditional chemically synthesized drugs and moving toward biologics.
Biologics being drugs manufactured from living organisms.
Yes. Think of complex monoclonal antibodies, advanced targeted cancer therapies, mRNA vaccines, and the new wave of GLP-1 weight loss medications.
Ah, the Ozempic and Wegovy stuff.
Exactly. These drugs are miraculous, but because they are biologically derived, they are incredibly fragile. They are essentially complex protein structures suspended in liquid.
So if you expose them to room temperature for too long, or if a shipping container vibrates too violently during transport?
The proteins denature. They unfold, they clump together, and the drug is completely ruined.
Like cooking an egg white. You can't uncook it.
Perfect analogy. It becomes useless or potentially even dangerous to inject.
So how does Ashland's vialosucrose fit into this?
Vialosucrose is a highly specialized, ultra-pure sugar compound. When Ashland's pharmaceutical clients manufacture a fragile biologic drug, they formulate it with this vialosucrose.
Okay.
The sugar molecules essentially wrap around the fragile proteins, acting as a microscopic stabilizing shield. It prevents the proteins from clumping together or degrading while the liquid is sitting in the glass vial on a clinic shelf for months, waiting to be injected into a patient.
That is incredible. So Ashland isn't taking the massive high-stakes gamble of trying to discover a new cure for cancer or a revolutionary weight loss drug themselves.
Not at all.
They are simply selling the utterly essential high-margin preservation technology to the massive companies that do make those discoveries.
It is the classic picks and shovels investment strategy applied to the modern biotech gold rush. They provide the enabling technology.
And again, because these biologics are so sensitive and so heavily regulated,
the barrier to entry for a competing chemical company to try and copy Ashland's high-purity stabilizers is astronomically high.
Okay, so the life sciences segment is clearly the crown jewel. The demand is inelastic, the regulatory moats are deep, and the innovation pipeline is perfectly aligned with the future of medicine.
That is the good news.
Right. That's the thriving metropolis. But now we have to cross the tracks and look at the struggling part of town in our tale of two cities.
The Specialty Additives segment.
This was painful to read. Revenue plummeted 11% year over year, dropping down to $102 million.
A massive drag.
Yeah, this is the heavy anchor that dragged the entire consolidated revenue number into negative territory. Why did this segment collapse so aggressively?
Well, if we pull back and look at the broader macroeconomic landscape, this Specialty Additives division is the legacy remnant of Ashland's portfolio that is still highly exposed to industrial cycles and construction trends.
And the primary unavoidable culprit here is China.
Exactly. The CEO, Guillermo Novo, didn't attempt to sugarcoat this during the call at all.
In fact, he joined the earnings call live from Shanghai, presumably to get a first-hand look at the damage.
Right. He explicitly blamed the revenue drop on structural overcapacity and severely weak consumer demand weighing heavily on their coatings business in the region.
When we talk about coatings in the specific specialty additives context, we are predominantly referring to architectural paint, right?
Yes. The massive volumes of paint used on residential housing complexes, commercial skyscrapers, and infrastructure projects.
But Ashland doesn't make the paint itself. They make the secret sauce that goes into it.
Correct. They manufacture advanced chemical additives, specifically rheology modifiers.
Rheology modifiers. Explain rheology.
Rheology is the study of how matter flows. Think about the physical experience of painting a wall. If the paint is too thin, it drips everywhere and doesn't cover the old color.
Right.
If it's too thick, it clumps up and you can't spread it smoothly with a roller. Ashland's additives are the microscopic chemical structures that control that exact thickness.
Oh, I see.
They ensure the paint flows smoothly off the brush, levels out perfectly flat on the wall to hide brush strokes, and, importantly, keeps the heavy color pigment suspended evenly in the can while it sits in a warehouse for 6 months, rather than sinking into a solid brick at the bottom.
It basically makes paint behave like paint. So it's a vital ingredient. But if the Chinese real estate market is completely imploding, which has been front page news for years with the collapse of developers like Evergrande,
then new construction halts.
Exactly. And no new construction means no massive orders for millions of gallons of architectural paint,
which directly cascades down the supply chain, resulting in a sudden, brutal drop in demand for Ashland's rheology additives.
But the lack of demand is actually only half of the problem here, isn't it? The CEO specifically used the phrase structural overcapacity. That is the real crisis.
Yes, because the chemical plants in China were built for a boom that no longer exists.
Let's talk about that.
For the last 2 decades, China experienced the largest, most aggressive real estate and infrastructure boom in human history. To feed that insatiable demand for construction materials, domestic Chinese chemical companies took on massive debt to build sprawling, state-of-the-art additive manufacturing facilities.
They just extrapolated the growth curve forever.
They did. And now that the property bubble is definitively popped, the demand has vanished. But those massive chemical factories are still sitting there.
And remember our discussion about fixed costs from earlier.
Exactly. Those Chinese factory operators have massive debt payments and massive fixed operating costs. They literally cannot afford to simply turn the machines off.
So they keep producing the paint additives even though nobody in China needs them.
Yes. They overproduce, which leads to a catastrophic glut of inventory, which instantly triggers a vicious race-to-the-bottom price war. Everyone is aggressively slashing the price of their additives just to generate any cash flow possible to keep the lights on.
It creates a massively deflationary environment for that specific chemical.
And that pain isn't contained within China's borders. Because the Chinese domestic market can't absorb the volume, those domestic chemical companies are now aggressively exporting that artificially cheap excess capacity overseas.
They're flooding other markets.
I mean, flooding the markets in Southeast Asia, the Middle East, and Africa, putting intense competitive pricing pressure on Ashland's operations globally.
So Ashland is caught in the crossfire of a sovereign real estate collapse.
It's a brutal situation.
And it wasn't just the Chinese construction market dragging down the Specialty Additives segment. Management also pointed to generalized global construction softness, specifically citing weakness in the non-structural repair and remodel market.
Which is a direct consequence of the global interest rate environment.
Right. Let's trace that logic for a second. If mortgage rates are sitting near 7% in the U.S., homeowners are terrified to move. But they're also hesitant to take out massive home equity lines of credit to do major renovations.
Exactly. If your roof is actively leaking and destroying your living room, you fix it. That is structural, non-discretionary spending.
You have to do it.
But if you just want to update the aesthetic color of your exterior siding or do a massive cosmetic remodel of your kitchen, you defer that project. You wait for interest rates to come down.
That deferment of discretionary repainting directly translates into lower sales volumes for Ashland's architectural coatings additives in North America and Europe.
Yes.
Okay, so the macroeconomic headwinds facing the Specialty Additives division are severe, structural, and frankly, largely outside of management's direct control. I can accept that as a painful reality of the current economic cycle.
It happens.
But this is where I want to push back. This is where we have to critically analyze management's narrative, because the weakness wasn't contained to just the industrial side. Let's look at the third major division, personal care.
The segment that is supposed to be the resilient consumer-facing engine.
Exactly. If the thesis is that consumer products are immune to macro shocks, then personal care should be thriving. Yet, organic sales in the personal care segment declined by 1%.
Yeah, that was a surprise.
And the reasons management provided for this drop felt incredibly messy. They claimed they took a hit because of unplanned customer plant outages in North America.
Right.
And then, in a completely separate incident, Ashland suffered a massive $10 million EBITDA blow because their own massive chemical plant in Calvert City, Kentucky, experienced severe mechanical failures during an equipment upgrade.
It is a totally valid area for pushback. When you see multiple overlapping operational failures occurring in the exact same quarter, you have to stop and interrogate the data.
Right. Let me float my initial skeptical reaction when I read the transcript. When management says, oh, our sales dropped because several of our customers' factories all magically broke down at the same time, it sounds suspiciously like the classic corporate "the dog ate my homework" excuse.
It definitely raises eyebrows.
Hey, are we absolutely sure this isn't just underlying consumer demand destruction that management is trying to mask as a bizarre supply chain anomaly? And furthermore, are we sure the Calvert City breakdown isn't indicative of a systemic execution problem at the management level?
Because losing $10 million from one broken facility is a massive unforced error when your total quarterly profit was only $58 million.
Exactly.
Well, your skepticism is entirely warranted, and the market clearly shared that skepticism, which is why the stock price struggled. But to get to the truth, we have to meticulously separate the customer issues from Ashland's own internal failure.
Okay, let's tackle the customer plant outages in the personal care segment first. Explain how a customer's broken factory actually hurts Ashland.
According to Jim Minicucci, the executive who leads the personal care division, these outages were entirely localized on the customer side. We are talking about several very large North American personal care product manufacturers.
The massive consumer brands that purchase massive vats of Ashland's raw ingredients to mix into their branded shampoos, body washes, and lotions.
Precisely. So Ashland had the advanced preservatives and the biofunctional actives fully manufactured, sitting in barrels on a loading dock ready to be shipped.
But the customer literally could not receive the shipment because their massive automated assembly lines and mixing vats were halted due to mechanical failures or localized supply chain bottlenecks.
Exactly.
But if consumer demand is still strong, why wouldn't the customer just stockpile the raw ingredients in a warehouse until their assembly line is fixed?
Because modern manufacturing operates on incredibly strict, just-in-time inventory models. These massive consumer brands do not have infinite warehouse space to store liquid chemicals.
Ah, right.
If their production line stops, their intake of raw materials must instantly stop as well to prevent a massive logistical bottleneck.
Okay, so Ashland's sales volume dropped purely because the physical delivery mechanism was blocked.
Yes, and management was very careful to emphasize that this was absolutely not demand destruction. They tracked point-of-sale data fiercely. The end consumers in retail stores are still consistently buying the shampoos and lotions.
So the underlying demand is healthy.
Yes, those specific customer plants are now fully repaired and back online, and Ashland explicitly expects to recapture that delayed sales volume over the subsequent quarters as the customers run their lines hot to restock their depleted retail shelves.
They deferred the revenue, they didn't lose it forever.
Exactly. In fact, if we mathematically strip out the impact of those specific isolated customer outages, the core personal care segment would have actually posted low single-digit growth for the quarter rather than a 1% decline.
Okay, I will accept the premise that the customer outages were an unfortunate, isolated logistical blip. But if we look past the broken assembly lines, what is actually driving that underlying low single-digit growth?
Right. What are the products?
If consumers are buying, what specific technologies are these cosmetic companies demanding from Ashland?
What is genuinely fascinating here is the massive outperformance in the highly specialized subsegments that Ashland has specifically targeted for aggressive innovation. While basic commoditized soap ingredients might be flat, their advanced biofunctional actives portfolio grew by double digits year over year.
Biofunctionals. Let's translate the jargon again. When we say biofunctionals, we aren't talking about the cheap lathering agents in a dollar store body wash. We are talking about the high science, ultra premium ingredients, right?
We're talking about the biological cutting edge of the cosmetics industry. These are the active ingredients engineered to interact with human cellular biology to produce a visible physical change.
And they specifically highlighted a massive breakthrough product they recently launched called Collapeptyl.
Yes, Collapeptyl. The transcript dedicated significant time to this. They mentioned that it was engineered to mimic 20 different collagen sequences found naturally in human skin.
It is a remarkable piece of biotechnology. It is essentially a highly synthesized, complex peptide structure.
Right, because as humans age, our natural production of collagen, the structural protein that keeps skin firm and elastic, rapidly degrades. That degradation is the biological mechanism that causes wrinkles and sagging skin.
So the cosmetic industry has spent decades trying to figure out how to put collagen back into the skin.
But you can't just rub raw collagen on your face. The molecules are too large to penetrate the dermal barrier.
It just sits on top.
Exactly. So Ashland engineered Collapeptyl as a specialized peptide sequence that can absorb into the skin and basically signal the local cells to behave younger.
Wow.
Management claims it provides what they call flash hydration within minutes of application, and over time visibly corrects the appearance of deep structural wrinkles.
It is literally the holy grail of the multi-billion-dollar anti-aging cosmetic industry.
And this highlights the brilliance of their pivot. When a massive luxury cosmetic brand completely reformulates their flagship $200 face cream to feature Collapeptyl as the star ingredient,
that brand is not going to suddenly stop buying the ingredient from Ashland just because the global economy enters a mild recession.
Exactly. The demand is incredibly inelastic. It's the lipstick effect on steroids. Consumers might delay buying a new car or skip a luxury vacation, but historically, they refuse to compromise on their premium personal care and anti-aging routines.
That is the sticky, resilient consumer demand management is relying on. And the biofunctionals weren't the only bright spot. They also reported above-market volume growth in their microbial protection line.
Which is a highly sanitized way of saying they make preservatives.
Yes, but it is crucial to specify that these are highly advanced next-generation preservatives.
Right.
The entire personal care industry is undergoing a massive formulation shift. Consumers are aggressively demanding clean beauty products, cosmetics that are organic, natural, and free of harsh synthetic legacy chemicals like parabens.
But the fundamental biological problem remains. If you make a natural face cream composed of water, organic oils, and plant extracts, and you leave it sitting in a warm, humid bathroom for 3 months,
it becomes a perfect petri dish.
It will violently erupt with dangerous bacteria and black mold. You absolutely must preserve the product to protect the consumer. But you can no longer use the cheap, highly effective synthetic chemicals of the past.
It's an immense chemical engineering paradox.
And solving that paradox is incredibly lucrative. Ashland has engineered proprietary, nature-identical preservation systems that keep these clean beauty cosmetics entirely safe from microbial contamination, while still allowing the brands to maintain their strict all-natural marketing claims on the label.
That's smart.
Because they solve this complex formulation riddle, they are aggressively capturing market share globally from legacy preservative suppliers.
Okay, I am thoroughly convinced. The underlying foundation of the personal care business is exceptionally healthy. The biofunctionals are booming, Collapeptyl is a verifiable hit, the clean preservatives are capturing market share, and the customer factory outages were merely a temporary delay in revenue recognition.
Yes, all true.
But we cannot let management off the hook for the second operational failure. We have to talk about Calvert City. The customer outages were bad luck. Calvert City was a massive, unforced internal error that destroyed $10 million of profit.
It absolutely was an internal failure, and it is the single biggest operational red flag in this entire earnings report. Every investor needs to monitor this situation obsessively.
Let's pop the hood on Calvert City, break down exactly what this facility does and how an upgrade went so catastrophically wrong.
Calvert City is an absolutely massive, sprawling, highly complex chemical manufacturing complex located in Kentucky. It is the industrial heart of Ashland's supply chain.
Okay.
This facility doesn't necessarily make the final finished additives. It produces the core foundational monomers, the fundamental chemical building blocks that feed directly into their higher value polymer production lines. Specifically in a chemical chain they refer to as VPPVP.
And those PVP polymers are the crucial ingredients that get funneled into everything from high-hold hairsprays to the pharmaceutical tablet binders we discussed earlier.
Exactly. If Calvert City stops producing those foundational monomers, the entire downstream supply chain for multiple high-value segments slowly starves to death.
So what broke? Did a reactor explode?
No, it wasn't a sudden disaster. It was the planned maintenance operation that spiraled out of control. Management scheduled a massive upgrade to replace a major aging piece of critical infrastructure within the plant.
But as anyone who has ever tried to renovate a 100-year-old house knows perfectly well, when you pull down the living room drywall to simply replace a single leaky pipe, you inevitably uncover 5 other catastrophic problems you didn't know existed.
You find out the electrical wiring is completely corroded, the support beams have severe termite damage, and there's asbestos in the ceiling.
Exactly. A 2-week plumbing job turns into a 6-month structural nightmare.
That is precisely what happened on a massive industrial scale at Calvert City. The CEO explained that they successfully installed the new equipment, but during the highly sensitive commissioning phase...
That's when they slowly bring the plant back online, right?
Yes, which is when engineers slowly bring the new high-pressure vessels up to temperature, test the specialized valves, and attempt to integrate the new hardware into the existing decades-old chemical flow. They suddenly discovered a cascade of additional, deeply hidden, unexpected mechanical issues within the surrounding legacy equipment.
The new part worked, but the old parts connected to it started failing under the new operating parameters.
Exactly. And in a high-temperature, highly volatile chemical manufacturing environment, you cannot simply ignore a failing valve or pressure irregularity and hope for the best.
No, that's how people get hurt.
Right. The safety protocols require you to immediately abort the startup, shut the entire massive unit back down, vent the systems, and begin a painstaking, highly technical diagnostic process to locate and repair the secondary failures.
And every single day that massive plant sits idle and cold, it is incinerating money.
The financial consequences of chemical downtime are brutal. This single botched upgrade compressed Ashland's total corporate adjusted EBITDA margins by over 250 basis points for the quarter.
To put real dollars to that percentage, it cost them $10 million in pure profit in Q1 alone. And because Calvert City feeds multiple divisions, the pain was spread out.
Yeah, it hit everywhere.
$4 million of that hit was absorbed by the high-flying life sciences segment. Roughly $4 million hit the personal care segment, and $2 million dragged down their intermediate segment.
It was a massive operational failure.
And this brings us directly into Section 3. Management guidance. Because this lingering, highly expensive Calvert City issue perfectly tees up management's outlook for the remainder of the year.
Unfortunately, the problem did not stay neatly contained in the first quarter.
No, it bled heavily into the future. And this is where the narrative of the earnings call dramatically shifts from looking backward at Q1 performance to desperately trying to model the forward-looking risks.
Right.
Let's break down the immediate headwind looming on the horizon. The Q2 warning. Management flat out stated to analysts that they expect another massive $11 million temporary financial hit, isolated specifically to the upcoming second quarter.
And we need to dissect the anatomy of that $11 million drag, because it is driven by 2 distinct, highly frustrating factors.
It's a combination of the Calvert City nightmare dragging on and, bizarrely, the weather. Let's finish the Calvert City thought first. Why are they taking another hit in Q2? didn't they fix it?
Well, when management gave their initial guidance a few months ago, their engineering teams believed they could identify the secondary equipment failures, source the necessary specialized replacement parts, and have the plant fully commissioned and operational before the end of the first quarter.
But the reality of industrial repair is never that clean.
The repairs are taking significantly longer than anyone anticipated. It is a highly complex, iterative process. Fix a valve, run a pressure test, find another leak, shut it down, start again.
It just drags on.
The timeline is now extended deep into the second quarter. Management admitted they do not expect the Calvert City unit to be back at its normal optimized operating rates until very late in Q2.
So the plant is still limping along, bleeding fixed costs, and then, as if the mechanical failures weren't enough, they get hit with an act of God. The weather issue. Did a hurricane hit a facility?
Not a hurricane, but a brutal wave of severe winter weather across the mid-Atlantic region of the United States.
The deep freeze.
The CFO, Michael Whitaker, noted that they experienced brief, totally unexpected operational outages at multiple different manufacturing sites due to sudden freezing temperatures and adverse weather conditions.
Now, to be fair to the operations team, they managed to execute these emergency shutdowns safely. There were no reported injuries, no environmental incidents, and surprisingly, no disruption to customer supply. They had enough finished inventory sitting in insulated warehouses to continue shipping orders.
Which is good.
But shutting down and restarting massive chemical plants on short notice is an incredibly expensive logistical nightmare.
It is the absolute enemy of efficiency. It causes massive incremental spikes in energy costs as you try to rapidly reheat massive vessels. It requires bringing in emergency maintenance crews on expensive overtime.
And the downtime itself.
And most importantly, it results in highly disruptive, unrecoverable downtime where the factory is producing absolutely nothing.
Okay, so we have the Calvert City delay stretching into its third month, combined with the mid-Atlantic freeze, creating a massive $11 million financial crater in Q2. But here is where we really need your expertise to translate the accounting jargon.
Sure.
During the call, the CFO went into a highly technical, very dense explanation of why the financial recovery from this specific $11 million hole is so incredibly difficult. He repeatedly used a specific accounting phrase, absorption recovery. What does that actually mean for the retail investor trying to build a financial model for this stock?
This concept is arguably the most critical piece of financial mechanics to grasp when evaluating any heavy manufacturing company. It is all about the unforgiving mathematics of fixed cost absorption.
Break it down for me. Use an analogy.
Imagine you own a mid-sized commercial bakery. Every single month, your core operating expenses, the lease on the massive industrial space, the lease payments on the giant convection ovens, and the salaries of your master bakers cost you exactly $10,000.
Okay.
That $10,000 is a hard fixed cost. You must pay it regardless of what happens.
The landlord doesn't care if I bake bread or sit in an empty room. The rent is due.
Exactly. Now, in a normal, healthy month, your bakery produces 10,000 loaves of bread. From an accounting perspective, that $10,000 fixed cost is absorbed across the inventory at a rate of exactly $1 per loaf.
Simple enough. The math works perfectly. And if I sell that bread to a grocery store for $3, I have a fantastic, healthy profit margin.
But what happens if your main industrial oven suffers a massive mechanical failure and sits broken for 2 weeks? That month, you only manage to bake 5,000 loaves of bread.
But the rent is still $10,000.
Precisely. You still have to pay the full $10,000 fixed cost. But now, because your production volume plummeted, that fixed cost has to be absorbed by a much smaller pool of inventory.
Oh, I see.
Your fixed cost absorption suddenly skyrockets to $2 per loaf.
Which instantly annihilates my profit margins. I took the financial hit.
Yes, your margins are crushed. Now, eventually, the mechanic fixes the oven. You are back in business. Can you instantly recover the money you lost during those 2 weeks of downtime?
Well, no. Just because the oven is working today doesn't change the fact that I paid the rent last month with zero revenue coming in.
Right.
The only way I could mathematically recover that lost profit is if I suddenly forced the bakery to run double shifts, baked 15,000 loaves the next month, and magically found enough customers willing to buy all that extra bread to average my costs back down.
And that is the absolute fundamental crux of Ashland's massive headache right now. The CFO explicitly detailed that roughly 2/3 of that $11 million Q2 hit is purely a volume-related absorption impact.
Because the factories were down.
Because the Calvert City plant and the Mid-Atlantic plants were shut down or limping along, they produced vastly less physical volume than planned. Therefore, the massive fixed costs of running those chemical complexes skyrocketed on a per-unit basis, completely destroying their profit margins for those specific product lines.
But wait, earlier you said they had enough inventory in the warehouses to keep supplying the customers during the weather outages, so they still recognize the revenue from selling the product, right?
Yes, they successfully sold out of their existing pre-made inventory stockpiles, but they did not manufacture the replacement inventory.
Yeah. So to financially recover from this absorption hit, they don't just have to turn the Calvert City plant back on. They have to run the entire facility at absolute maximum red line capacity to massively overproduce new inventory to finally spread those massive fixed costs out again.
Precisely. They have to bake the extra 5,000 loaves of bread. But here's the massive operational catch, and this explains why management is adopting such an incredibly cautious, defensive posture right now.
What's the catch?
They cannot even begin to recover that lost absorption until the Calvert City unit is fully repaired, completely stable, and back at normal, sustained operating rates.
Which, as we established, isn't going to happen until the very end of Q2.
Which means the actual financial recovery process, the clawing back of those lost margins, cannot fundamentally begin until the third quarter.
And even then, they can't just blindly turn the machines up to maximum capacity and pump millions of gallons of chemicals into storage tanks if the end customers aren't actually ready to buy it.
Exactly. And this relates directly back to the struggling Specialty Additives segment, specifically their HEC network, which produces the paint additives.
Right.
The recovery of fixed cost absorption in that specific network depends entirely on the strength of the upcoming spring seasonal demand lift. The architectural paint season in the Northern Hemisphere heavily concentrates between April and September. You paint houses when it is warm and dry.
That makes sense.
However, actual visibility into how aggressive the paint companies will be with their raw material orders typically doesn't firm up until March.
So management is looking at this complex matrix of risks and saying, we technically have the manufacturing capacity to run the factories hot, massively overproduce inventory, and mathematically recover our margins on a spreadsheet in Q3, but we absolutely are not going to do it until we actually see the whites of the customer's eyes.
Exactly. They need to see hard, confirmed purchase orders in March and April before we crank the multi-million-dollar machines to 11.
It is the absolute definition of a prudent, highly disciplined, show-me posture from executive management.
They are making a very specific, deliberate choice. They are prioritizing the long-term health of the balance sheet and the preservation of free cash flow over the short-term desire to blindly pump out inventory just to make their quarterly income statement look slightly less bruised.
Because did they guess wrong?
If they guess wrong, it is a disaster. If they assume the spring paint season will be massive, run the factories at maximum capacity, and the demand doesn't materialize because interest rates stay high, they will be left holding massive warehouses full of incredibly expensive, rapidly depreciating chemical inventory that they cannot sell.
It would trap millions of dollars in working capital and destroy their balance sheet flexibility.
That is exactly the risk.
That is fascinating. They are willingly accepting the short-term pain of terrible margins in Q2 to aggressively protect the long-term structural health of the company.
And this incredible balancing act leads to what I consider the most surprising headline of the entire earnings call.
The full-year guidance.
Right. Despite all of this Q1 operational mess, despite the $10 million Calvert City failure, and despite the explicit $11 million warning for Q2, management actually narrowed their full-year FY26 adjusted EBITDA guidance.
They didn't slash it in panic. They just tightened the high and low ends of the range. They are now officially projecting $400 million to $420 million in total adjusted EBITDA for the full fiscal year.
And furthermore, they are stubbornly, almost aggressively sticking to their previously stated target of achieving $30 million in hard structural cost savings for the year.
Let's stop and look at the math, because on the surface, it feels impossible. If you take a $10 million unexpected hit in Q1, and you are preemptively guiding for another $11 million hit in Q2, how on earth do you preserve the full-year profit guidance?
It seems contradictory.
The math doesn't add up unless they have a massive ace up their sleeve in the second half of the year.
The ace up their sleeve is the relentless execution on the structural cost savings initiatives, combined with the underlying accelerating strength of the life sciences and personal care innovation engines. They are controlling what they can control.
Let's dig into the cost savings. They launched a $90 million multi-year structural savings program. They successfully achieved $25 million of those savings last year. And they are absolutely locking in $30 million in savings this year.
Right.
Where exactly is that $30 million coming from? It can't just be cutting travel budgets or turning down the thermostat in the corporate office.
No, it comes from incredibly complex, gritty, highly unglamorous operational restructuring. For example, their massive optimization of the HEC manufacturing network.
Okay, what did they do there?
Management made the brutal, necessary decision to completely shut down an older, highly inefficient manufacturing plant located in Parlin, New Jersey.
They didn't just scale it back, they closed it entirely.
Closed it, decommissioned it, and aggressively rebalanced all of that production volume to a much more modern, highly efficient, consolidated manufacturing site in Hopewell, Virginia.
That sounds like a massive undertaking.
Now, to be completely transparent, physically scaling up the production lines at that Hopewell site is currently causing some minor, higher-than-expected unit costs in the short term as the engineers work out the mechanical kinks of the new volume.
Right, teething issues.
But once that specific facility stabilizes and achieves peak operational flow, it structurally, permanently lowers the baseline cost structure of the entire company.
The CFO specifically mentioned in the transcript that they are targeting $50 to $55 million in total annualized savings just from this one network optimization project alone. And he noted there's potential upside pushing it to $60 million once the underlying macro demand in China eventually improves and they can fully absorb the fixed costs at the Hopewell site.
And that is just one project. They are simultaneously running aggressive programs to consolidate smaller, inefficient mixing plants across Europe.
It's a global effort.
They're investing heavily in enhancing their global sales and operations planning software. They're even deploying advanced artificial intelligence models to improve their standard cost accounting and predictive inventory forecasting, ensuring they never overproduce in a weak market.
When you systematically strip tens of millions of dollars of permanent structural bloat out of a corporate entity, it provides a massive financial buffer. It acts as a shock absorber against temporary freak operational hits like a frozen pipe in Kentucky or a delayed valve replacement.
Precisely. And the cost cutting is acting as a bridge to the growth of their high-margin innovation platforms. As we discussed in depth, the innovate and globalized products, the low-nitrite excipients, the collapeptyl biofunctionals, the vital-sucrose biologic stabilizers.
The stuff that's really working.
They're all currently growing at double-digit rates. Management has explicitly committed to generating $35 million in incremental, completely new revenue just from these specific innovation platforms during this fiscal year alone.
So, when you blend the millions of dollars in permanent cost cuts with the massive injection of highly profitable new innovation revenue, management genuinely believes it will be mathematically enough to completely offset the Calvert City delays and the persistent macro weakness in China over the full 12-month period.
But it undeniably requires a massive, flawlessly executed second half of the year.
It does. It requires a severe second half weighting. Now, to be fair to Ashland, a second half weighting is historically normal for their specific seasonal business cycle due to the spring paint season and pharmaceutical production schedules. But the pressure is absolutely immense. They have exhausted their margin of error. They have to deliver.
And that reality brings us perfectly to the most crucial part of this entire analysis. We have broken down the underlying numbers, we have explored the macroeconomic tale of two cities ravaging their portfolio, and we have dissected the extremely complex fixed cost dynamics of their guidance.
Which means it is time for the ultimate question. Section 4, the bottom line. The reason you tuned in. What does this massive web of data actually mean for your money? Let's get to the bottom line.
What is your firm stance on the stock right now, given everything we've synthesized?
Here on the deep dive, we always promise to deliver a definitive, opinionated stance based on the evidence. And my stance on Ashland Inc right now is resolute. This stock is the absolute dictionary definition of a show-me story.
I am in complete agreement. The burden of proof rests entirely on management's shoulders.
Look, from a high-level strategic perspective, the vision is brilliant. The 85% pivot away from highly cyclical, low-margin industrial chemicals and the aggressive move toward resilient, high-margin, consumer-facing products makes total logical sense.
It does. We see the undeniable evidence that it works in life sciences with the pharmaceutical excipients. We see it working beautifully with the biofunctionals in personal care.
The underlying logic of the corporate transformation is intellectually bulletproof.
But the physical execution in the real world has been incredibly noisy and frustrating.
It really has. The constant barrage of operational missteps, the unplanned customer assembly line outages, the Calvert City plant breaking down not once but twice during a commissioning phase, the inability to manage weather disruptions efficiently, it creates a dense cloud of unreliability over the stock.
And if there's one thing institutional Wall Street investors hate more than bad news, it is uncertainty. It is extremely difficult for the market to justify rewarding Ashland with a premium, growth-oriented valuation multiple today when there is a persistent recurring pattern of operational hiccups that constantly masks the underlying health of the innovation engine.
The market is ruthlessly demanding flawless, boring execution to justify a higher multiple, and Ashland simply hasn't delivered a clean, boring quarter yet. So what is the highly actionable takeaway for you if you are currently holding ASH in your portfolio, or perhaps watching it closely and considering taking a position?
We have to split this actionable advice into two very distinct time frames, because the short-term reality is vastly different from the long-term potential. Let's outline the short-term bearish case first.
Proceed with caution.
If you are looking strictly at the next 3 to 6 months, the second quarter is going to be incredibly messy and likely quite painful to watch. Management has already telegraphed the punch. They told you directly they are taking an $11 million profit drag from the Calvert City delay and the weather outages.
And China.
Right. We also know for a fact that the severe macroeconomic weakness in China's coatings market is a deep structural issue of overcapacity. It is not going to magically vanish by the spring.
And crucially, because management is intentionally defensively holding back on overproducing inventory to protect their cash flow, the Q2 income statement is going to look artificially depressed due to that massive, unabsorbed fixed cost burden we spent so much time dissecting.
Right. There is simply no immediate positive operational catalyst expected in Q2 to drive the stock significantly higher. The headline numbers will likely look quite ugly on the surface when they report next.
But then we pivot and we have to look at the long-term bullish case, which is incredibly compelling if you have the stomach for the current volatility.
Yes. If you have the patience to look past the Q2 noise and the Calvert City headache, the underlying innovation engine of this company is legitimately humming. They are successfully engineering and launching high-margin biotech products that are perfectly aligned with massive, multi-decade global tailwinds.
The desperate industry shift toward more natural, clean, cosmetic preservatives, the severe FDA regulatory crackdown on nitrosamine impurities in pharmaceuticals, the massive explosion of biologic drugs that require specialized, highly engineered molecular stabilizers to survive outside of a freezer. Ashland is positioned directly in the path of all that capital flow.
Exactly. And while the top-line revenue might currently be fluctuating due to divestitures and macro weakness, the undeniable fact that they maintained a 15% adjusted EBITDA margin despite a 3% organic sales drop mathematically proves that their structural cost-cutting program is real, permanent, and highly effective.
So here is the final move. The actionable advice based on the data. If you currently own shares of ASH, our stance is a firm hold. Do not panic sell into the weakness because of the Q2 noise.
Hold on to it.
You are holding this stock specifically for that massive 50% free cash flow conversion rate. You are holding it because the balance sheet is an absolute fortress with $900 million in liquidity protecting you from downside risk. You are holding it to see the compounding mathematical benefits of the $30 million in structural cost cuts flow directly through to the bottom line when volumes inevitably recover in the second half of the year.
I completely agree with the hold rating. Selling now means you endure all the pain of the transition without waiting for the structural payoff. The extreme downside risk feels highly protected by the cash generation and the deeply resilient inelastic demand in life sciences.
But what about the listener who doesn't own it yet? What if someone is sitting on a pile of cash looking at the long-term thesis and wants to initiate a position?
If you are looking to buy, you must practice extreme discipline. Keep your powder dry.
Wait it out. Do not catch the falling knife before Q2.
Wait it out until the very end of the second quarter, or even until they officially report the Q2 numbers. Let them release the Nessie quarter. Let the impatient algorithms and the short-term market traders overreact to the $11 million financial hit. What you want to do as a strategic investor is wait on the sidelines for two highly specific, undeniable confirmation signals before deploying your capital.
What is signal number one?
Number one, management must officially definitively confirm that the Calvert City plant is finally fully online, fully commissioned, and actively running at normal, sustained operating rates without a single additional mechanical surprise. The internal bleeding must stop.
And confirmation signal number 2.
Number 2, you want to wait to see if the Q3 spring seasonal volume actually shows up in the data. Management themselves stated they are waiting until March or April to see the whites of the customer's eyes in the architectural coatings and construction markets before they ramp up production.
So you should wait too.
You should adopt the exact same strategy. Wait too. Once management confirms the spring season is genuinely strong and they officially begin that critical absorption recovery phase to claw back their lost margins, that is the exact moment the operational risk profile of the company drops significantly. That confirmation is your entry point.
I love that framework. Keep your powder dry, wait for the absolute confirmation of the Calvert City fix, and wait for the spring paint season to physically materialize in the order books. That extensive analysis brings us to the end of our primary breakdown.
It's a lot to digest.
But as we wrap up this deep dive, I want to leave you with a final, highly provocative thought, something to deeply mull over, or perhaps research on your own, that builds on the foundation of everything we've discussed today, but looks even further over the horizon.
And this specific thought touches on the ultimate upside potential for a massive structural valuation re-rating of the entire company.
During the live Q&A session at the very end of the earnings call, an analyst from a major bank asked management a highly specific, very pointed question about the rapidly exploding global market for GLP-1 weight loss drugs.
The Ozempic, Wegovy, and Mounjaro boom. It is arguably the single biggest, most disruptive story in the entire pharmaceutical industry, perhaps the biggest in decades.
Exactly. It's a cultural phenomenon as much as a medical one. Now, currently, these GLP-1 drugs are primarily administered via injectable pens. But the entire pharmaceutical industry, every major player with a research and development budget, is fiercely racing to develop a viable oral version of these GLP-1 medications.
A simple daily pill you can just swallow with your morning coffee, eliminating the need for needles entirely.
The market size for an effective oral GLP-1 is almost incalculable. But, as we discussed extensively earlier regarding vasosucrose, these GLP-1s are biologic drugs. They are complex, incredibly fragile peptide structures.
And the human stomach is a highly hostile, incredibly acidic environment designed by evolution to brutally break down complex proteins.
Exactly. Developing an oral version of a fragile biologic drug is an immense, incredibly difficult biochemical and engineering challenge. If you just swallow raw semaglutide, your stomach acid will destroy the peptide before it ever reaches your bloodstream.
The head of Ashland's Life Sciences division, Alessandra Faison, took that analyst's question and explicitly noted that the race for oral GLP-1s and other oral biologics represents a massive, significant opportunity, specifically for Ashland.
Why? Because successfully delivering a fragile biologic safely through the hostile environment of the human stomach requires incredibly advanced, high-throughput, highly specialized protective tablet coatings.
Coatings that must act as an impenetrable armor in the stomach, but then immediately and precisely dissolve to release the drug at the exact right moment once the pill reaches the more alkaline environment of the digestive tract where it can be safely absorbed.
She confirmed on the call that Ashland currently has multiple active development projects underway with some of the biggest pharmaceutical players in this space. They have a targeted pipeline of over 80 emerging opportunities specifically regarding oral biologics.
That's huge.
And crucially, they announced they are launching a brand new, highly engineered sodium caprate permeation enhancer this summer, designed specifically for this exact application.
Let's explain what that is. A permeation enhancer is a highly specialized chemical product that literally helps the large, clunky biologic drug molecule physically permeate the mucosal lining of the stomach or intestine so it can actually enter the patient's bloodstream, rather than just passing euclidly through the digestive system. It is the key that unlocks the door for oral biologics.
So here is the massive forward-looking question for you to explore on your own. If Ashland's highly engineered cellulosic excipients, their specialized coatings, and their advanced permeation enhancers become the critical, foundational, enabling technology that actually allows the massive multi-billion-dollar oral GLP-1 market to function at scale, Will Wall Street eventually wake up?
Will they stop pricing Ashland like a cyclical industrial chemical company hopelessly tied to the failing Chinese real estate market?
And start officially valuing it like a high-margin, utterly indispensable, high-growth biotech supplier. Because if you look at the market, specialized biotech suppliers trade at vastly higher, incredibly lucrative valuation multiples compared to traditional chemical manufacturers.
That is the multi-billion-dollar question hanging over the stock. If that fundamental identity shift finally happens in the collective minds of the institutional market, the upside potential is completely disconnected from where the stock trades today at $58.
It all ultimately comes down to execution. Can management finally get their corporate airplane rebuilt, get Calvert City permanently out of their repair shop, and conclusively prove to the market that the new high-tech consumer engine actually works without stalling?
Exactly. You pop the hood right now, and undeniably, it looks messy with the Calvert City delays, the massive fixed cost absorption issues, and the weather anomalies. But if that messy engine is actually a high-tech, high-margin biotech supplier just waiting to roar to life, that changes the entire investment game.
Thank you so much for joining us on this incredibly extensive deep dive. As always, use this comprehensive breakdown as a foundational starting point. Keep aggressively doing your own research and always keep looking under the financial hood. We will catch you on the next one.